All right, we're going to set up a trade in the SPX. This is August 31st expiration cycle. There are 52 days until expiration. I already have a position on in the August 31st. So if you are in the same trade or in a similar position, just want to pay attention and make sure you don't cross your existing strikes, thinking that you're selling to open where you're going to be actually selling to close something. Positions get really messy if you don't have software that will track of those things. So do be aware of that. What I'm going to do here is normally I would put in a 112 for a net credit given where the market is right now. And I'm not saying that we're going to crash here, but just looking at the price action, we are in a pretty strong uptrend. Even going back to the March lows, we made a matching high going back to February. We consolidated and then we took off at the end of May. We had a very slight pullback. It didn't even come down to test 21 EMA. We made a slight higher high relative to where we were in the middle of June. But here we have MACD is not making a higher high, so things are kind of getting a little heavy in my opinion. Now, again, this is not a reason to get out of the market or expect a crash here. I just don't want to add any more positive delta. And also another thing to consider where volatility is, putting on a trade with short out of the money naked puts, they don't decay the way they would normally decay. So that makes a trade where you collect a credit up front a little more tricky. I'm looking for maybe sideways and maybe a slight pullback over the next 45 days, as long as the market doesn't tank, and when I say tank, I mean go down, more than 10%. We can look at expected range, and this is based on current implied volatility, which again, keep in mind is relatively low. So expected range right now is somewhere about 4.5% from today's prices over the next 52 days. Is that a lot? Given where volatility is right now, it's kind of average, I guess. But if the VIX is going to rise to a more normal levels, relatively speaking, to a long-term average, if VIX goes back to 18, this range is definitely going to expand, and this position could potentially get hurt. So if the market runs away, obviously I'm not going to make the initial credit if this was a 112 bear trap. But given my other positions that I'm currently running, I have plenty of credits that I collected on the upside, so that's not really a concern here. What I am playing for is a potential pullback, and we can see how my T+0 line is going to look like over price and time. And this is not 100% accurate, because if we do pull back and volatility increases, these T+0 lines, right? So the red one is a T+13. So this is what my T+0 line will look like 13 days from today. If we pull back down to about 42.50 over the next 13 days, I can assure you that this T+0 line isn't going to look as nice, because an increase in implied volatility is going to push my T+0 line lower. But the idea is, at some point in the future, I would look for price to come into the bear trap, and that is where this trade makes the profit. So let me just go over the trade setup here. This is a 50-point wide put debit spread. I'm placing my strikes. My long strike is at 43.40. My short strike is at 42.90. So that's a 50-point wide put debit spread. I'm looking for a put debit spread that is trading for somewhere around $11 or so. And then to cover the $11 debit that I'm paying for this 50-point wide debit spread, I'm going to sell an out of the money put naked, also looking to collect somewhere around $11. So net, I'm paying $11 for the debit spread. I'm collecting $11 for my naked put that I'm selling. I should come out at about an even trade, meaning I don't pay anything as a debit, or I may collect a small credit. I was filled on this trade, and I posted this in the Income Navigator chat channel. I did get a fill for a 20-cent debit, and that is where it's currently trading for. So the breakdown here, there are 3 potential outcomes. If S&P 500 is above our long option of the put debit spread, which is at 43.40, at expiration, if S&P is above 43.40, we stand to lose 20 cents per one contract, or $20 or so. That's not including commissions or fees you may be paying to your broker. So on the upside, we have very, very small risk. And as I said earlier, if that is the case, I have a number of other trades that are currently going that will more than cover the 20-cent debit that I'm paying to put this trade on. Now, this trade makes the most money is inside the trap, which is between our out of the money naked put that we are selling and our put debit spread that we are buying. So this is a 50-point wide put debit spread. The most this spread could be worth is 50 points, or $5,000 per one contract, minus 20 cent or $20 debit that we're paying to put this trade on. So inside the trap, this trade could make 50 minus 20 cents. That would be $49.80, or $4,980, excluding fees and commissions. On the downside, that's where things get real hairy when market starts to move. Now, there are several ways that we could potentially manage this trade if things will start to get loose to the downside. I will post updates in this post thread, but the idea here, my stop loss, and I'm not setting any GTC orders. I don't like to use that. Instead, what I will do is I have a number in my head, and that number is slightly greater than my max potential reward inside the trap. So if I know that I could make 50 points inside the trap, I don't want to risk 120, 150 points, 3 times my max potential reward inside the trap. I go pretty even with my risk reward inside the trap. So if the most I could make is 50 points, I don't want to risk more than 55, maybe 60 points. So at any given time, if it cost me 55 points or $55 to $60 to close this trade, that is my stop. So if the trade is down about $5,500 to $6,000 per one contract, it's time to cut this trade and move on. It's that simple. Sure, before we get there, if the market starts to move to the downside, and obviously implied volatility is going to increase, and that's not going to help either. As we come down, you can take a look at my delta component here. Right now, starting off this trade, slightly negative delta, and this is on a 10 lot. So if you do a one contract, you will have pretty much no delta, right? So you don't really have a ton of directional exposure. But if we start to go down, say we go down to about 4,300, you can see my delta now went from -7 to about +14 or +13. So on the way down, as we continue to go down, you can see that my net delta of this position will start to increase. And what I am going to do is, if that is the case and we start to roll over and there's still a lot of time on the clock, I'm going to use either at the money debit spreads, or maybe just buy slightly out of the money debit spreads that will neutralize this position. Again, I want to stay as delta neutral as possible. Give this trade plenty of time for my short options to decay, and potentially have my put debit spread increase in value if we are inside the trap. And essentially, at some point in the future, if we are outside of the trap, we could lose very little. If we are inside the trap, we're going to make a handsome profit. And if we push far enough with enough speed and volatility, we could potentially lose a little bit more than what we plan on making inside a trap. I hope this was simple and I hope this was clear. If you have any questions, let me know. I'll post updates as they happen.